Well, thank you everybody for joining. I think we'll make a start now. So first of all, please can I welcome you to this joint webinar with ourselves, Simmons Gainsford and Memery Crystal. I'm Daryush Farshchi. I'm a business partner here at Simmons Gainsford, and I'm joined by my colleague on my left, Anthony Rose, who's a tax partner here, and also on the screen you've got Stephen Ravenscroft, Head of Employment at Memery Crystal, and Euan Fergusson, specialist on compensation and benefit matters. As we all know, the COVID-19 pandemic has created a number of challenges for all businesses and individuals to address. Us as Simmons Gainsford as accountants and Memery Crystal as lawyers, we spend a lot of time over the last few months discussing these challenges with our clients, and that's what's driven the webinar today, and the collaboration piece that we need to do on these issues that present both legal, tax and accounting matters as they arise. And I think what we know is the global pandemic has really, challenged businesses. But the one aspect that we need to all be aware of is the importance of retaining talent. It's that talent that builds the business, helps grow the business. And that's what's driven really the subject of this webinar. How do you retain and manage staff in these challenging times? How do existing share schemes work? What is the impact of all the various government guidance that's come out around this and the new schemes and the interaction between them, and try and deal with that as a business while looking at the other challenges that come with that, with revenues dropping and potentially needing to find ways to remunerate people other than cash, which is where share schemes can come into play as well. In terms of the etiquette for today, all I would ask is that you all remain on mute. That should be the case anyway. And obviously we're trying to make this as interactive as possible. So please feel free to use the question facility within Zoom, which you should find towards the bottom of your screens, just to click on, raise a question, and we'll look to address that as we move through. But actually we've also been fortunate to have a few questions in advance, which we will start with to sort of start the ball rolling and take it from there. So without further ado, we'll kick off with the first question, which Stephen, I think sort of probably will lead with you to start off with, in terms of people who have actually already issued share options to their employees. They were done at what is considered a high value and now are considered underwater during the pandemic, and what can they do to look at in terms of reviewing those options now?
Great. Well, thanks very much, Daryush, and it's a pleasure to join you on on today's presentation. So I suppose if we're looking at share or incentive awards or bonus plans and how we go about changing them from an employment law perspective, and that's the kind of angle that I'm looking at these issues from. The first point is, well, what kind of change are we trying to make? Are we trying to make a change which is going to be more beneficial for the individual, in which case the likelihood of there being any employment law risks or difficulties are relatively low, because the employee or the individual will clearly welcome some kind of recalibration to his or her bonus plan or share awards if they are currently underwater or they've been detrimentally affected by the current financial circumstances. But if we're doing something to their awards, their rights, which is perhaps not advantageous for them, then the first thing I would want to do is look to see how those awards or rights have been granted in the first place, and in particular to check whether they've been baked into the employment contract itself. We would normally try and advise at the outset that employers don't put things like share awards within the context of the employment contract itself, that they keep those awards separate with award certificates and the plan rules, of course. But from time to time, you will see employment contracts which have reference to incentive awards, and of course, more commonly, employment contracts will contain some form of bonus provisions. And so the question is the change that the employer is seeking to make going to be a change to something that's already within the contract of employment? Is it something that is a change but is within its own discretion? Or is it a change that, that it would effectively be making as a unilateral change to an existing term of the employment contract? Now, most types of bonus and share incentive type awards that are reflected in the employment contract will hopefully have reference to the rules of the plan or the rules of the scheme as amended from time to time, so that you can quickly refer across to the plan rules or the scheme rules to determine whether the changes are permitted. And that's maybe something that Euan will explore a bit further. But if you have a very clear express statement within the employment contract that maybe requires a change, then notwithstanding that change might be permitted under the rules of the scheme, if the contract itself gives some kind of form of guarantee, whether that's a guaranteed level of bonus or a guarantee of the mechanism by which bonus is calculated, or a guarantee as to particular share rights or options, then you potentially have difficulty because you are going to have to seek to change that with mutual consent. If there is discretion, and the general approach to discretion within the employment contracts is that as long as the employer does not exercise its discretion irrationally or perversely, then it should be able to rely upon those discretionary powers to make the necessary changes. There has been some developments in case law quite recently around discretion and whether or not the public law concepts of what they call Wednesbury reasonableness have kind of crept into the employment context, which means that actually the test isn't only whether or not discretion has been exercised irrationally or capriciously, but it's whether it's been exercised in an unreasonable fashion in such a way that no reasonable person could have exercised it that way. Now, although that sounds relatively similar, it is certainly that second part of it, that exercising in an unreasonable fashion in a way that no reasonable individual or person would have done, is definitely broader than exercising discretion subject to the rules of it not being capricious or irrational. We're still waiting to see how that approach is going to be developed. At the moment, there's a bit of ambiguity in the case law as to whether or not it'll get picked up. But if it does get picked up, then there is an additional consideration for the employer in terms of how it might exercise its discretion to make these kinds of changes or the changes that it's proposing. I think the last point from the employment side is that irrespective of all of this, any employment relationship has an underlying mutual implied duty of trust and confidence. And that means that the employer should consider how it goes about communicating, what kind of notice it gives to the individual who's going to be impacted by the changes, and generally consider that it goes about making those changes in a way that respects that underlying duty of trust and confidence. It's fairly unlikely, if you have a broad discretion, that by exercising the discretion you're going to breach the implied duty of trust and confidence. But there might be situations where, for example, you might tell somebody that you're exercising the discretion and, by the way, you're exercising it tomorrow, so they don't have any forewarning or any input or any understanding of your reasons behind it. So that's the final point, I think, to consider from a strict employment perspective. As I say, I expect Euan's probably got some comments on what the plan rules may permit when you come to making changes.
Yeah, thank you, Stephen. That's very good. And yeah, certainly, that's legal side. But yeah, we all know you've got an option agreement. It's got various terms. What are the next stages for looking at changing those option scheme rules, or what would you look at, I guess?
Yeah, I think, well, thank you very much, Daryush and Steve. Yeah, no, you're both absolutely right. I think the context that we're looking at this is potentially that, as we've said, the share price is such that it's been so badly affected that in the case of options, the exercise price may now be significantly what we would describe as the market value is significantly underwater. So the exercise price is much higher. And indeed, there could also be impact on performance conditions that may have been set by reference to certainly executive awards, where the performance conditions may be linked to financial performance of the company. The traditional benchmarks are always linked to earnings per share or total shareholder return, etc. So with that in mind, if we are looking to amend these awards and to try and make sure they continue to be viable and to meet the purpose for which they're intended, and we have to then look at potentially amending their terms. That would be your starting point. And as we've discussed then, in order to determine that, you really need to look at the rules themselves. What are the provisions that are currently in place that govern those particular awards? Normally, options or indeed any other form of equity-based award, in the UK in particular, they're granted normally by reference to a set of plan rules, which set out the sort of fundamental terms on which the company can grant on a sort of perennial basis. And then with regard to individual terms, those are normally covered off in separate award agreements or an award certificate or an option certificate, call it what you will. But the specific details relating to that particular individual or any particular individual would be set out in the award agreement. And so it's a combination of both documents, both the rules and the underlying agreement, that will probably be your starting point with regard to whether or not you can make the amendments that you're looking to achieve. In the case of majority of certainly UK plans, I would typically expect there to be a sort of fairly broad power of amendment, especially in the case where the proposed changes will be to the benefit of participants. So you wouldn't necessarily have to go back to participants for their consent if you're clearly making a unilateral decision which is to their advantage. That said, the powers of amendment may also act in such a way that you may be required to seek shareholder consent in the case of making amendments, particularly in contrast where the amendment is to the benefit of participants. Whether or not you need to go to shareholder consent is probably going to be a function of certain additional documents, including the articles, possibly in relation to a shareholder agreement, but primarily also for listed entities, particularly those on the main market, on the stock exchange. There are fairly strict rules regarding amending share plan awards, and they do require also that shareholder approval is required. So there are various things that need to be considered if you do want to make amendments to existing plans.
Thank you very much. An interesting question actually has come up is, can we just change the option prices? Anthony, I don't know if you've got a view on that one.
Well, the problem there from a tax perspective is normally if you're looking at tax advantage schemes like EMI, CSOP, etc., you will have agreed valuation with HMRC in advance, and that kind of sets the benchmark and the implications for employees going forward.
Yeah, I mean, I think the issue you have is that the options would have to be completely reissued with a new valuation agreed and taking into account all the limits historically is where we'd sit on that. So it's that even though they're undervalued, we can't just change the price. We need to negotiate with HMRC. But I think that's sort of actually the question here that was more of a general question, which was sort of what are the sort of tax and corporate governance issues that you need to consider when actually putting in a share-based award scheme.
Yeah.
Again, Anthony, if you want to lead on sort of some of the tax side of that, which sort of links into the question is it a case of just starting again? And what do you need to consider if you pick on the tax bits? Then we can go back on the legal corporate governance side afterwards, maybe.
I think you've got to be very careful when you're making amendments that you're not creating a new award effectively, because HMRC in certain circumstances will view something very fundamental as being a new option. So there's some quite helpful guidance within HMRC's share schemes manuals where they look at what would be considered to be fundamental changes in terms of, for example, number of shares acquired, the price at which they can be acquired, and when they can actually be acquired. So I think that's quite important. Additionally, where we're looking at discretion and changes on performance conditions, there was quite a helpful tax case a number of years ago involving the Revenue and the Burton Group, and overall the decision was found in favour of Burton. And if I just read out a couple of bullet points that were quite relevant, it was considered that the additional conditions could only be imposed by the directors in circumstances which were clearly stated at the date of the grant of the option or before the beginning of the financial year in which the performance targets were related, or at the time when the option holder first held a relevant job. Additional conditions which could be set were limited to specific matters and to being reasonably considered to be fair measures of performance of the option holder holding the relevant job, and substantial variation of such conditions was only permitted if the directors considered that different conditions in relation to the job would be a fairer measure of the performance of the holder of the job and would reasonably be less difficult to satisfy than they would have been without the amendments. So again, just picking up on one of Euan's points, it's really the fairness side that's important, I think.
Yeah. And the other part then is if we go back to new options, is looking at the valuation, and that's obviously, you know, it should be from a share plans perspective, it's available information about the performance of the business at that point in time and what's impacting it. And obviously, COVID has impacted a lot of businesses, and in some cases, therefore, as we're saying, if it's underwater, suppress the option value. Therefore, if you can have a lower option value today, in terms of all these sort of limits, which are £250,000 for an individual under EMI scheme, obviously that lower value that we can get today can sort of help with the amendment of a scheme. So if you previously issued options at higher values, you started to use some of those, obviously lifetime and the limits that people have available, the lower valuation that we might be able to achieve in sort of the COVID world, we can help that to issue more options. And I think the other point to sort of, if this is a brand new scheme and you are looking to reward employees, is that obviously that lower exercise option price actually means that the incentive they're getting when the hopeful eventual upturn in the business occurs is a much bigger gesture in terms of what you're rewarding them on a day. I don't know, Euan, if you've got something to pick up sort of on the, so there's a question around sort of the corporate governance that you need to consider on making share awards, whether you've got some more to add there.
Yes, I mean, I would certainly just add to what I've already covered off, which is when you're making amendments, or indeed if you're starting to consider things like even the possible cancellation and re-grant, which is likely to be more beneficial, I think, at least in addressing some of HMRC's concerns, then you certainly, again, do need to consider the higher level corporate governance. So notwithstanding what's in your rules, which in most cases should reflect the corporate governance, but they may or may not, but you do need to then consider, as I say, the wider issues with regard to do you need shareholder consent, and therefore, at least in the private company context, have a look at your articles, or more importantly, have a look at your shareholder agreement. Or in the case of a listed company, make sure you do consider the listing rules or other rules which the company, for say a name listed company, has agreed to comply with. I think it's worth mentioning also, perhaps even just anecdotally, that I recently just chanced my arm by going back to the revenue just to check if it was possible to reduce an exercise price but without affecting the actual nature of that particular option. And I was told that uncategorically, no, you cannot do that. And we knew that was going to be the answer, but it was nice to have it, I suppose, in writing. So the bottom line is, even if you are permitted by your rules and agreement to make a certain amendment to a particular option, particularly in the context of the tax advantage arrangements, including EMI, that you might be permitted under the rules, but you still need to consider what HMRC's approach will be. And in most cases, they're likely to take a fairly restrictive view of it. I think, though, the other thing that's worth bearing in mind, and Anthony read out the number of key issues which HMRC often consider as part of their analysis as to whether an amendment effectively amounts to a re-grant. I think one of the things is if your performance measures are no longer likely to be fit for purpose, again, you're likely to see an amendment in those. And I think provided that amendment is correctly drafted and it's part of the written terms of that performance measure, then you might have greater latitude, at least addressing HMRC's concerns. So an amendment to a performance condition as compared to lowering the exercise price might not be quite as problematic. That said, you still have issues with shareholders potentially. Listing rules, for example, do not like the idea of retesting of performance conditions, and I think that extends to the amendment of performance conditions. So you really need to be very careful there.
Yeah. It's also how stringent the original documents are that are on the table in front of you. But I suppose the two options out there is review and amend, or review the option to start again, isn't it? Obviously, there's probably a little bit more cost for starting again because of the valuation and the exercises you need to go through as a business. But actually, the end result might be something that's probably more fit for purpose.
Yes.
And moving forward, I guess.
I think that's right. I mean, in my experience, I would say cancellation and start again tends to be the cleaner situation, and avoids this potential problem of, particularly in the case of tax advantage plans, has the change amounted to effectively a re-grant, and in the case of SAYE and CSOP, is it a fundamental, is it a key feature of the scheme? So by cancelling and re-granting, you're avoiding those questions. But as you've already touched on, Daryush, I think it's quite an important point to flag, particularly in EMI, which we're heavily involved in that arrangement. When you're cancelling and re-granting, you do need to consider your limits. You touched on the £250,000 limit per individual and the 3 million in aggregate. If you have granted an option within 3 years, and even if you've cancelled that option, those options will still be counted towards those limits. So you need to be really careful that when you're considering that you're not inadvertently going to create a disqualifying event for EMI purposes, at least. I think the other thing to consider in terms of limits is, or in terms of or timing, is we've also got what used to be referred to as good old entrepreneurs relief, which for EMI, to maximise your capital gains tax relief, you've got to hold your awards for at least 2 years. If you go down the cancellation and re-grant route, then you are resetting the clock, and so at least for EMI, you have to start again for another 2 years before you can maximise your capital gains tax relief under current rules. But we'll wait to see as and when the next budget does materialise whether that's going to be changed.
I think we've got to stay at relief on the capital gains tax there, at least with our friend number 11 at least delaying the budget now to next year, because I think we've all seen the press and read about it. Capital gains tax is something that I think he is going to address, rightly or wrongly.
Right. Well, watch the space, definitely.
Yeah, very much so. No, thank you. I think you're right, and it's interesting. I suppose the one thing about thinking about it again is maybe again we talked about the fact that people are, well, again, one of the questions about people having changed incentives package, changed this. Maybe share schemes are a new way to extend the group of people you're offering that incentive to across the business. No business wants to just give away equity, I guess, but we talked at the beginning about trying to retain talent, and if you're in a business where you said you're struggling to maybe pay what you wanted to pay or give pay rises, is this a different way of looking at it, providing it meets the relevant rules? Because another question that came in, and again maybe more on the employment side, Stephen, is that have any changes made to salaries or other working arrangements such as furlough or the job retention scheme impacted the bonus and the incentive arrangements really? What do we need to be looking at?
Common problem, sorry.
Right.
Absolutely. I guess this is for those employees who've been unfortunate enough to have been placed on furlough leave under the job retention scheme, and the question there would be, have they accepted reductions in salary in line with the provisions of the job retention scheme? So just to kind of recap, the government, when the scheme was first in place, would pay up to 80% of wages capped at £2,500 per month, and that has been on a sliding scale now, coming down since 1st of August, where the employer NICs and pension contributions were no longer covered, and then September the government's contribution went down to 70% of wages capped at £2,187 per month, with the employer making up the extra 10%, and then from the 1st of October that drops to 60% with the employer making up 20%. So there have been lots of different approaches to how furlough leave has been applied within different companies. In some companies, the employer has topped up to 100% of salary for those employees who've been placed on full furlough leave. There has been the flexibility to have some work performed during furlough leave since the 1st of July. In other companies, we've seen that employees have accepted a reduction in salary so that they've reduced down to those capped rates. And clearly, if to any extent they have variable remuneration, and particularly bonus arrangements which are linked to actual salary, question as to how these types of reductions in salary will impact upon those arrangements, and indeed if those arrangements will provide anything when the relevant kind of decision time arrives. There are some parts of an employee's remuneration which still have to be paid at full rate, irrespective of any employee's agreement to reduce their general salary. So, for example, it's now clear that statutory notice pay and statutory annual leave should be paid at normal full salary, not the reduced rate. But there may well be other contractual parts of their remuneration where any agreed reduction in salary has a knock-on effect on those other incentive arrangements. There was one point, and Euan can probably comment a little more on this, there was one point that was up for some debate when the furlough scheme first came into play, in terms of the time commitments, because an employee initially, to qualify under the job retention scheme, was not permitted to perform any work whatsoever, so that their time commitment effectively went down to zero. and you, and maybe you can comment, but I think I recall at some stage there was a debate as to how that played into some of the requirements for EMI.
Yes, Steve, that's absolutely right. This was as a fundamental requirement to qualify under EMI. Individuals have to meet the working time requirement, and that's set out in the legislation. And this is on average 25 hours a week, or if less, at least 75% of working time. So going on to furlough was seen as clearly a potential breach of that requirement. And that requirement really applies in two ways. First of all, it's a qualifying requirement, so that in order to grant new options to an individual, new EMI options, that individual has to meet that requirement at the point of grant. And then if, once the option's been granted, if the individual then ceases to meet that working time requirement, that cessation of qualification, as it were, comprises a disqualifying event for EMI, which means that any further gain in value from the time of that disqualifying event will no longer qualify for the beneficial income tax relief under EMI. So you've potentially got a double whammy. So I'm pleased to say that, we were involved in addressing this point and seeking clarification from HMRC, just to make sure that this wasn't going to happen. And it's not a dissimilar event to individuals who are in, for example, the military reservists. And so we wanted the same treatment to be applied to individuals in furlough. So as I say, I'm very pleased to announce that, or to confirm that, and they backdated it to 19th of March actually, that for the revenue will accept if an individual, if he would otherwise have met the scheme requirements, but doesn't do so for reasons connected to the coronavirus pandemic, then their qualifying criteria will not be affected. And that also applies to the reduction in working time as a disqualifying event. So so technically it could have been a big problem for, I think, many people, but thankfully the revenue have addressed this. And we're just waiting for legislation to be made in the, I think in the current or indeed the next finance bill, just to reflect what HMRC have already announced. So this applies to EMI options granted before and after the 19th of March. So that's good news.
I think it's nice to see some logic and common sense in a government policy that links through and we all agree with.
Yeah, absolutely. Absolutely.
It's so good. I mean, I think you touched it. We were talking about obviously the old job retention scheme. We are now moving to obviously the job support scheme. The Chancellor said, and I think it's quite right, not every job can be saved and retained, but they are now looking to support, and there are some differences in those new rules, and I guess some pros and cons as to what businesses want to do, whether they want to take it up. I mean, I think the big thing from our side of seeing, we saw it when flexible furlough came in, is that obviously you can do part-time work. Yes, it is more prescribed now, a third of time, and obviously you need to top up a third, the government giving you a third. But I think what it's doing is allowing people to sensibly and flexibly bring their businesses and people back into the workplace as required. And I think the one thing people need to be aware of, you don't need to have used furlough to use a job support scheme. It's open to everybody again. New start date from the 23rd of September on payroll. So it's really, sit back and don't go, we didn't need furlough while we need this. I think it's really for businesses to sit back and plan how they think the next 3 months is going to pan out, and cross sectors. Obviously that's going to be very different, and challenges that we're going to face if your business is in a lockdown area versus a non-lockdown area, and what that means. I mean, I don't know, that's sort of my practical, what I've seen in real businesses. That's what we're sitting down and discussing with our clients as to how best to fit it into their new working practices. I mean, that's what that's the challenge we're all facing today, I guess, isn't it? New working practices. And I don't know where you and Stephen, from a legal perspective, whether you see any issues again, but is it the same? Is it consultation? Is it making sure we don't do anything unreasonable? And what's the best way to address it?
I mean, that's a good thing. I think from an employment perspective, I would certainly defer to Steve just on that. But I think one point I would just like to emphasise, that I think whilst we're in difficult times and cash may be short, I think, I hope it doesn't sound the wrong way, but I think we might have been focusing certainly on some of the earlier questions on potential problems with dealing with existing arrangements and the issues that need to be considered when we're amending them. But I think one shouldn't lose sight of the fact that I think discretionary share plans have probably as strong a place to play now as they ever have done, because I think it can be seen as a fairly cost-effective way for employers to benefit employees, to deal with the key issues that incentives are typically required to address, i.e. retention, recruitment, retention, and indeed incentivization. So I think at this moment in time, I see a lot of scope for moving more towards the equity-based type of arrangement. We've talked a lot about EMI, and if companies do qualify, I would certainly encourage them to continue to look at that in particular. EMI is not the only thing. Another equity-based plans can and do have a place to play to part, but I would or part to play even. But certainly EMI is something that I think you can take major advantage of, particularly where share prices have dropped quite significantly. And then we can maybe squeeze more options into that very tax efficient wrapper. Steve?
Yeah, no, I agree. I mean, I think maybe two slightly different points, but on the point you just made, Euan, I think that we've definitely seen an increase in activity of people having to pay very close attention to retaining their key talent in the current circumstances, and of course it's better to try and do that using if you like, softer methods, including incentivization, than having to try and rely upon your hard post-termination restrictive covenants to stop people from joining competitors. So I think that the importance of incentive arrangements is greater than ever, at a point where cash might be slightly in limited supply in the short term, but the underlying health of the business is good, and you have very key people who you are extremely keen to retain within your business. Then I totally agree with you in that this is a time to make sure that you focus on those issues and have the right incentivization and reward plans in place. On the job support scheme, I think that there are the initial views on it have been quite mixed. Some people look at it and say, well, why would I pay 55% of wages to get 33% of my employees' time, and why would I job share 3 employees working 33% of the time and pay them 150%, where I could have 1 person working 100% and pay them 100%. So there are some debates about its effectiveness. I think that do remember that if you're converting somebody who has been on the job retention scheme onto the job support scheme, and if you can keep them employed up to the 31st of January, then there's the job retention bonus that comes into play. And what I would say is, I think that where the job support scheme hopefully will be useful for employers is particularly where you have individuals who perform relatively unique roles, but you just don't have the need for those roles to be performed at 100% of the time at the moment. So that you and if you look at the fact sheet that was provided by the government last week on the job support scheme, it's clear that actually the more hours you can provide them with, the lower the kind of premium that you're paying for their time. So I think that if you can get them up to, say, 70% of their hours, then you only pay 80% of their wage, and the government comes in and pays 10%. So I think there are going to be very specific facts that every business has to consider in terms of how it can use the scheme. But in one way, sadly, the government has had to implicitly acknowledge that people who are on full-time furlough at the end of October and who can't be accommodated within the workforce can't be covered any further. But I think on the positive aspect of it is that it just gives employers a bit more flexibility to think about their workforce planning over the next 6 months.
Yeah, I think everyone has to reflect that while, sadly, one stated there's going to be plenty of people out there to be employed, recruitment has its own challenges if you let people go, and even in a market with a lot of people will have its costs associated with it as well, won't it? So it's a fine balancing act, and we're working with clients, as I said, looking at those numbers and working out, where those pinch points are and what generally works, and putting forecasts together, as we all know, cash is king, and it's about retaining as much as possible within these businesses in these difficult times. Yeah,
and you're absolutely right. I mean, redundancies are an expensive exercise. If you're making long-serving employees redundant, then they've got long notice periods. They've got they're going to be at the upper end of the statutory redundancy payments. Those are probably single lump sums that an employer will have to find, and is the alternative of being able to support them on a shorter time basis over the next 6 months more preferable. And absolutely, that's where your expertise, I'm sure, is very helpful for your clients to plan financially ahead like that.
Very much so. Very much so. So we've done 45 minutes. We've got another 15 minutes to go. I'm just wondering, are there sort of any specific questions from the floor, so to speak, that we can look to address? Hopefully, for those who've got the question answers, it's down at the bottom of the screen. If you want to ping something through, we can have a look at that for you. But I think the general theme of what we're saying here is, it's sit back, review, isn't it? Have a look what's already in place. Have a look about, looking forward. Obviously, that's what the biggest challenge for any business now is, looking forward. But what do we see happening? And where do we need to look at the staff? Who are those key people? And what can we do to keep them either different to what we did before or replacing what was there? And it's revolving and reviewing, isn't it? And I think that's what we're spending a lot of time with our clients at the moment, is talking it through. And I think I know we spend a lot of time working with you guys. We work with our clients, and we're there to start those conversations, because that's the starting point. And there's a lot to take in. I mean, I think we've taken in more new legislation in the last 6 months than we would do in a normal 12-month cycle. And we're here to help digest, understand, and make it make sense for your business. And that's the point, isn't it? There's no one size fits all here, is there?
Yeah, I absolutely agree with that new legislation point, Daryush. It's felt like doing my entire kind of employment law training in 6 months, relearning coronavirus related law. Another kind of positive aspect, I think, of the job support scheme is just that actually we're going to have time to kind of review and understand this. Whereas when the flexible furlough scheme was brought in, I think employers found it quite challenging. It was quite complicated to work out how to use it, and there only appeared to be a relatively short window during which it was going to be available. So anecdotally, I feel that some of my clients said, we're just not sure whether it's going to work. And by the time we've worked out if it's going to work, it probably won't be worth it. Whereas at least now, there is a run-in, a run-off of the job retention scheme, but then a 6-month period for the job support scheme, where once we get the more detailed guidance and legislation, really, it'll be much more helpful for employers to be able to spend time considering that and really working out whether for a 6-month period it is something that they can use to accommodate and support and retain their staff.
Yeah, and I think that's very true, and I think that's one pleasing thing with the legislation is that a lot of the stuff was being brought in. It was given a cliff edge date, and we only found out what the new rule was 2 days before the old rule ended, and that was making it very difficult to make business decisions. We've now got a bit more of a runway. We've got 12 months extra on VAT, the job support scheme, and the VAT rates are lower for a longer period. I think far from certainty, because that's not a word we've heard a lot of in the last 6 months at all. But it is allowing everybody to sit back and make some as proper plans as they can do, given the circumstances, and knowing that there's sort of, I guess, flexible support out there on the most important thing, cash, which is what we're, that's what businesses, that's what fuels every business, isn't it? So
yeah.
So yeah, that's where we are. I think we don't have a plethora of questions coming through, but it's been very entertaining afternoon, and I think from you, Euan and Steve, thank you for the legal side of it. I think it's nice to bring that joined up thinking together as well, which is often what's needed on these projects.
Absolutely. So it's been a pleasure to join, and I'm sure that there'll be details following the webinar, should people want to get in touch with any of us here.
Yeah, no, very much so. We'll circulate around to the participants a little note of some things that we've covered, and yeah, we're here to be contacted, email, phone, to deal with those sort of questions that always generally come up after the event. Is how do we address what's here? And I know that most businesses, when they put these plans in place, they are specific. So there'll be specific questions to your needs and your businesses, and we'll happily deal with those as we need to. I think unless there's anything else, I just want to say thank you to everyone who has joined us today. Thank you for taking up your time, and we look forward to meeting you all again. Hopefully next time we start to do some of these things, we'll be hosting them in an office, and a bit more real life interaction as well, which I think we all still need. The screens help, but you can't beat a bit of human interaction as well.
Thank you very much.
Thank you.
Thank you.
Bye.
Bye.